Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Peter Schiff is back. He's chairman of Euro-Pacific Precious Metals, EuroPackMetals.com, the home of Peter Schiff's official gold blog. Here in Canada, Euro-Pacific in Toronto, Montreal and Vancouver, and at EuroPack.ca. Hey, Peter, good to talk to you again.
Hey, good to be back.
Want to point our friends to your official gold blog in your latest video. Is now the time to sell gold? Great stuff. Here's the key takeaway. Nobody knows where the bottom is. It's not going to last long. In fact, the price is going to go way higher. Now, what's driving the price, and what are we looking at ahead for gold?
Well, I think right now the price is being driven by the speculators. You know, there were a lot of speculators, a lot of hot Wall Street money that chased the gold market after it had gone up dramatically. You know, gold went from under 300 to well over 1,500 before anybody on Wall Street really started to buy it. But I think some of the hot money came in when the stock market kind of stagnated and people who had missed the boat tried to, climb on. Recently, though, with the stock market headed higher again, I think a lot of the speculators decided to put their money elsewhere, and that started the ball rolling. And then with all these statements coming out of the Fed and everybody jumping to the wrong conclusion regarding monetary policy, more pressure came on the market. And now I think you have a lot of shorts in the market. A lot of speculative money is shorting gold mining companies. They're hoping to profit from the continued decline. But I think the shorts are going to be in a lot of trouble. I think they're going to lose a lot of money. I think eventually, sometime soon, you're going to see a violent reversal in the price of gold. And I think the shorts are going to be trapped. And it might have been easy to sell the gold, but it's not going to be easy to buy it back. I think they're going to have to do it at much higher prices, and there's going to be some big losses for the shorts. But real investors should just take advantage of other people's foolishness and buy more gold and, in particular, gold mining stocks while the sale is on. In fact, I'm so convinced that this is the best opportunity ever to be buying gold mining stocks that I am launching in about 2 weeks a gold mutual fund, a gold mining mutual fund. I've managed mutual funds now for years. I've never had an exclusive gold fund, and I'm coming out with my first one in mid-July, and I decided to launch that specifically because of this opportunity that I think is unique and I think represents a great entry point for people who want exposure to that sector.
Peter Schiff is our guest here on This Week in Money. One of the key things you talk about in the video, Peter, is the false narrative a lot of folks seem to be operating under. Get this, the latest from the Prudential Financial folks. The U.S. economy continues its recovery. Toronto's Globe and Mail, a star-spangled recovery. Why the U.S. economy is showing signs of life. And you're saying, hey, wait a minute, that's not true at all.
No, it's not. I mean, yes, you can see the stock market has gone up. The real estate market is going up, but that's exactly what was happening in the U.S. economy in 2005 or 2006. But was the U.S. economy in good shape? No. It was on the verge of a collapse. The same thing is happening now. It's the same cheap money policies that fueled the rise in stock and real estate prices then that's fueling it now. The only difference is the monetary policies are even more reckless, and the problems that they've created are even bigger. So now we're on the verge of an even bigger collapse than the one we had in 2008. And once again, the establishment, the media, mainstream Wall Street firms, they've got it completely wrong, and they're about to get blindsided yet again.
The U.S. economy, of course, not really recovering. You're saying it's going to head for a recession, and that means not less QE, as Bernanke and his buddies have been hinting at, but more QE. What's that going to do?
Well, unfortunately, yeah, it's not going to help. It's just like throwing gasoline on the fire. You know, Ben Bernanke has said that if the economy doesn't recover the way he believes it is, that he's going to do even more QE than he's already done. Now, since Bernanke has always been wrong about what he thinks the economy is going to do, he's basically telling us, if you understand, that more QE is coming. But what Ben Bernanke really should be doing is admitting that the QE hasn't worked. If he keeps expecting the economy to get better, and he's constantly disappointed because it's not, and each time he just does more of what didn't work, only bigger, when is he going to admit that he's got the wrong cure for what ails us? In fact, the reason the economy is so sick is because his cure is what's toxic and making it sick. But unfortunately, we're going to get more QE, which means the economy will keep getting worse, and the price of gold is going to go a lot higher.
Peter, you're one of the few people who seem to be able to see through the Fed smokescreen that is confusing a lot of us these days. And tell us what you think will happen when the market figures out that we're going to get much more QE.
Well, what happened when the markets figured out that people with bad credit couldn't repay their mortgages? The market imploded for subprime, and what happened when people figured out that .com stocks we're never going to make any money. They collapse. So, there's going to be a complete reversal in investor psychology when they realize how wrong they've been. So you're going to see a drop in the stock market, a drop in the real estate market, a drop in the dollar, a rally in the price of gold. And what is the Fed going to do in response to all this? Well, most likely is more of the same, more QE, which eventually isn't going to work at all. Eventually, if you take enough drugs, you don't get high, you die of an overdose.
Yeah.
And I think we're dangerously close to overdosing on QE.
Peter Schiff from Euro Pacific Precious Metals, our guest here on This Week in Money. Peter, you've taken a lot of heat over the years for your gold calls from both bulls and bears, depending on what's going on with the price. It goes something like this: Peter Schiff is wrong, and the recent decline in the gold price, of course, proves it.
Yeah, they had to wait a long time to say that, because I've been bullish on gold publicly for over a decade, and the price of gold has really done nothing but go up. It did go down in 2008, and so I took some flack then, but then the price of gold tripled, and now it's going down again. And, it's funny how people who have been bearish on gold the entire way up from 260 to 1900, they were bearish the whole way. Now they're coming out and saying, "We told you so. We told you not to buy gold." Schiff doesn't know what he's talking about. Meanwhile, it's still 4 times higher than it was when they first told people not to buy it and that I was wrong. And, if you go back in history, the biggest bull market we had in gold thus far was the one we had in the 1970s. And that got started in 1971. Nixon cut the gold, severed the link between the dollar and gold. And gold went from $35 an ounce or $42 an ounce up to 200 by 1974.
Okay.
Then it pulled back to 100, and they were saying the same thing. The bull market is over. The gold bugs are wrong. The price of gold is going to keep on falling. It's never going to rise again. The economy is in great shape. And then what happened in the next 3 years? We had, double-digit inflation, and the price of gold went up 850%. So, I think we're setting ourselves up for something similar, only maybe even bigger this time around.
Peter, we are talking about gold a lot these days, and not just because of the price, but we are looking here in Canada at the survival of our mining sector. Very important. So it is getting kind of personal up here.
Yeah. And, a lot of these gold mining companies, these big gold mining companies, their bonds are now basically at junk status or barely above it, and the stock prices are at, decade lows. You've got major Canadian gold mining companies today with share prices lower than they were when gold was at $300.
Wow.
And one of the things that's amazing is how much more expensive it is to mine gold than it was 10 years ago. Yet everybody keeps saying there's no inflation, yet mining costs have gone through the roof. I mean, one of the major costs other than labor is energy. Look at oil prices. 10 years ago, a barrel of oil was less than $20 a barrel.
Ouch.
Now it's about 100.
Yeah.
So, you got a 5-fold increase in the price of oil. You don't have a 5-fold increase anymore in the price of gold. And it's not just oil prices. It's all sorts of prices. And governments have made it a lot more expensive to mine. Environmental protection. So gold needs to go up just simply because it's that much more expensive to mine it. Forget about the fact that people need to buy it as an inflation hedge. The cost of producing is going down. And now that you've got gold trading, in many cases, less than the cost that most mines incur to produce it, that means you're going to have a huge collapse in supply of gold, which is another reason that the price is going to go so much higher. And another point that people probably overlook is that let's say we get a sharp rise in the price of gold from here. Let's say gold immediately goes back up to 1,500, 1,600. Those gold companies are not going to reverse their plans to shut down some of their mines. Mm-hmm. They're not going to reinstall the CapEx they just canceled. They're not going to refund their exploration budgets. They just got burned by the volatility. They're going to be very cautious going forward in increasing capacity. So I think you're going to have to see gold prices well north of $2,000 an ounce before any of these major gold companies does anything to increase production.
Now, we know that, Peter, that it's costing at least $1,200 an ounce for these guys to mine this stuff. If we see a protracted period where it may drop down to below 1,000, for example, we're going to see a big rationalization process with a lot of the junior miners.
Well, I don't think you're going to see a protracted period of sub-1,200 gold. I think that as soon as the downward speculative pressure is off the market, it's just going to go right back up. Because once the speculators have sold all the gold they can sell, the buying, the real demand is going to continue. And once that happens, who's going to sell the gold to the legitimate buyers? Mm-hmm. There's nobody left, because nobody that owns physical gold is going to sell it at these prices. And so once the speculators, have a full position on, I think the only thing that can happen is the price starts to go up. And once it starts to go up, now the speculators are going to try to unwind their shorts. And where are they going to get that gold? How are they going to buy it back? Yeah. I think you get a short squeeze in the metal, you get a short squeeze in the stocks, and I think the price can rise as quickly as it fell. Who knows? It might even rise quicker. I mean, they normally say that markets take, the stairs up and the elevator down. But in this case, we might end up taking the elevator up too.
Peter Schiff on This Week in Money. Great quote from you last week that I'd like you to tell us about here. You said there hasn't really been a crash in the price of gold. There's been a crash in investor expectations when it comes to the price.
Yeah, well, the price of gold is down now. From its peak, it's down about 40%. And, it is down now this quarter, 20-something percent. But it's not a spectacular crash. In one big day. It's not like the 1929 stock market crash, or even the 1987, where the Dow lost 20% of its value in a single day. We haven't seen that big a drop in a 24-hour period in the price of gold, but it is a very substantial decline in a short period of time. There has been a collapse in gold mining stocks, and I think that has to do with expectations of the future price of gold. But I think it's really been a change of psychology. But if you look at $1,200 gold and say, wait a minute, 3 years ago, $1,200 was an all-time record high for the price of gold. So we've simply got back to what used to be a record high. I mean, think about when the Dow hit a record high in 2007, and it didn't get back up to that high until this year. Mm-hmm. And meanwhile, it had about a 50% decline before it did that. And there wasn't as much bearishness on the U.S. stock market, despite an even more dramatic decline than what we've just had in the gold market, than we have now. And meanwhile, it took the stock market many, many years to make a new high. Look how long it took the Dow Jones to take out the high from 2000.
Yeah.
So we've had bigger drops in the stock market over longer periods of time that didn't evoke the type of widespread and almost unanimous bearishness. We went from over 90% bullish among professional investors about gold 2 years ago to 99% bearish. You can count the bulls on one hand, and you're talking to one of them.
Peter, how can we keep our eye on the ball here with gold and gold miners going forward?
Well, just look, I think people have to take advantage of these prices. Yeah, you can't be scared that these companies are going to go bankrupt, and you also can't worry about the fact that it might go down after you buy it, because it might go down, or probably will go down. Just resign yourself to that. Realize I'm going to buy this gold stock, and the price is going to go down after I buy it. Just be okay with that. Because if you're trying to get the rock bottom, if you want to make sure that it never goes lower, you're probably going to end up buying it much, much higher if you even buy it at all. I think more people are going to miss the opportunity because they're afraid to take advantage of it.
Peter Schiff, chairman of Euro Pacific Precious Metals. He's online at europacmetals.com. Here in Canada, europac.ca. Peter, as always, a pleasure, my friend. Thank you for talking to us.
Thank you.
This Week in Money is archived online at talkdigitalnetwork.com.
Rick Rule is founder of Global Resource Investments, a member of the Sprott Group of Companies. He's online at sprottglobal.com. Rick specializes in natural resources. That's what we're going to talk about this week. Rick, it's great to have you back on This Week in Money.
Always a pleasure, sir.
Crazy couple of weeks we've had the last little while. Last week, Ben Bernanke hinting at the end of QE, the resultant chaos in global markets. This week, the Fed, Rick, in full damage control, telling us we misunderstood Bernanke's statements about winding down QE. What kind of a message do you think the market sent to these guys, and are they getting the message?
Well, I think this is an outgrowth of really 2 decades of Fed manipulation of the markets, or the attempt of them to manipulate the markets. This may be a sign that they're losing control. I don't really know. I suspect that one subtext of this that people need to understand is that there is some sense that Bernanke probably didn't mind interest rates going up a little bit, in the sense of attempting to deflate a bond bubble and maybe slow down the housing recovery. And that leads to a second point, which is that a lot of people mistake quantitative easing as simply a monetary tool, that is, adding liquidity to an economy that's challenged by solvency. Quantitative easing is much more than that. Quantitative easing is providing a market for government bonds to fund a deficit that they otherwise couldn't sell in the market.
Yeah.
And the great sort of unsung truth about quantitative easing that people need to understand is that one function of the $85 billion a month that they're spending is, in fact, counterfeiting. It's issuing specious currency to fund a current account deficit that they couldn't otherwise fund. So in one sense, Bernanke got to have his cake and eat it too. Talked up interest rates a little bit, cooled off a liquidity-driven rally, while at the same time causing clamor in the markets for him to continue to counterfeit.
This is just a trial balloon that they're throwing up to see what happens?
I suspect.
Yeah.
Yeah, I suspect. I don't understand how, from their point of view, they can get the paper sold that funds their deficits otherwise.
Who is the end user for all these bonds? It's governments themselves, is it not?
Sure.
Are they selling it to themselves?
Of course. Not much has happened to change the U.S. deficit. And although I focus on the U.S. deficit because I'm American, your listeners need to understand that there is not one G20 nation in the world that has a balanced budget. This is something that's going on around the world. Ironically, of course, the U.S. dollar is a very strong currency. The joke is that it's the worst currency in the world except all the others. The United States would seem to be the world writ large in the context of constraining government expenditures to the underlying economy's ability to provide.
Now, Rick, for most of us, QE is a relatively recent phenomenon. I guess the question here that you have raised a number of times, can central banks worldwide really afford to end as what you're basically calling counterfeiting?
Well, I'm not an economist. I'm a credit analyst. I know from my own viewpoint that I'm on a personal strike against government securities, yes, for moral reasons, but also because I don't believe that the interest rates that they're offering compensate me either for the decline in real purchasing power or the risk to them as credits. I suspect that until more people come to agree with me, they'll be able to get away with it. Remember that there are a couple definitions of confidence, and one of them sort of coalesces with the word con. And people on a global basis would like to be conned. I mean, people want to believe that the big thinkers of the world, the Bernankes, the Obamas, the Abes, the Merkels, the Hollands, can cause a perpetuation of a system where we spend more money on ourselves than we generate in utility. It's a wonderful thing to believe that the leaders of the world, the big thinkers, can allow us to continue to live beyond our means. That's a problematic supposition from my point of view, of course.
Rick Rule from SprottGlobal.com here on This Week in Money. And one of the things you said this week at the Sprott Global site, interesting comment here. Liquidity, which is a word we've been hearing endlessly the last couple of weeks, liquidity is not a substitute for solvency. What's that mean?
Well, look at the U.S. as an example. The on-balance sheet liabilities of the U.S. federal government are $17 trillion. By the way, for your listeners, that's 17 followed by 12 zeros.
Wow.
It takes a long time to write and a longer time to pay off. But that's the tip of the iceberg. The Congressional Budget Office, not known for underestimating budget deficits, has suggested that the off-balance sheet liabilities, in other words, the net present value of future obligations, like Medicare, Social Security, federal pensions, things like that, adds $60 trillion to the total. So you're talking about a $77 trillion debt that's supposed to be serviced by a $17 trillion GDP economy. It's important to know that that whole $17 trillion isn't margin with which one can service debt. things happen out of that, like people have to eat, they have to go to school, they have expenditures. In fact, net private savings in the United States allegedly increased last year by $500 billion. So think about trying to service $77 trillion in debt with $500 billion a year in savings. The math is very, very, very bad. It's as though you had $1 million debt personally, and you had $6,000 cash in your wallet. The $6,000 cash in your wallet suggests that you don't have a problem until the $6,000 goes away. But when the $6,000 goes away, then solvency becomes an issue.
Time for me to take a page from the Fed and start counterfeiting.
Nice work if we can get it.
It sure is. Rick, let's take a look at what all this chaos has done to markets worldwide, to stock markets and bond markets, and how we as retail and institutional investors can take advantage of that. Where do we go now? What do we do?
Well, this is very interesting. You know, the U.S. public economy differs substantially from the U.S. private economy. And again, I'm talking to a Canadian audience in an American context. The U.S. private sector has done a very, very good job in shaping up both their balance sheet and their income statement. And I don't find the S&P 500 horrifically overvalued. I think there's some fantastic companies that are ridiculously competitive from a global point of view. I do think that we are going to have an unbelievable amount of volatility in markets. I wouldn't be near the long-term bond market in any currency.
Yeah.
I wouldn't touch those things with a barge pole. And of course, in the subjects that we're most interested in, natural resources and microcap natural resources, we are seeing incredible volatility. In fact, I remember the last interview that you and I did, when you were talking about how do bear markets end, and I said that they end in capitulation. Well, we're in capitulation now. We are absolutely, truly in capitulation. I don't know how long it will go on. I remember this occurring 3 times before. But we are certainly in the capitulation phase of a sell-off. It's my suspicion, but I don't have any knowledge of this, that the physical precious metals markets are oversold and are probably due for a rebound.
Okay.
I wouldn't expect that rebound in the near term to help either the major or the junior resource equities, although the resource equities have held up well in the last 2 or 3 days. But this capitulation selling normally gives way to a quiet period where both the buyers and the sellers are exhausted. And I suspect this market will work itself out. When I say this market, I mean the Canadian junior resource market will have a continued capitulation, ugly, comical, disastrous, whatever you want to call it, for 2 weeks or 3 weeks. Just real torture. Followed by a quiet sideways period. And towards the end of this year, I think you'll see a beginning of the bifurcation that we saw at the beginning of the year, where the top 5 or 10% of the issuers begin to move up in quiet fashion. But nobody notices because the great bulk of the companies in the market are in such desperate need of funding that they'll continue down towards their intrinsic value, which is, of course, zero.
Yeah, for sure. Rick, last time we talked, you were just back from the PDAC in Toronto, and the news headlines at that time, all the talk at PDAC was about how the junior miners, the junior resource companies in Canada, were starving for cash. That's when gold was at $1,600. Now it's below $1,200. These guys are in desperate straits.
I got to say, these issuers have real courage. I've probably had 100 financing discussions since PDAC. And management team after management team after management team has said, Rick, we can't do it at this price. We have to wait for the market to turn. Well, the market's turned. It just turned in a way they hadn't anticipated. John Kaiser talks about the fact that there's now between 700 and 800 issuers that don't have enough cash left to last the year.
Wow.
That's healthy. It isn't healthy for those shareholders or management teams, but it's healthy to take those silos, those receptacles out of a capital market that's strained. This Darwinian process, I remember in 1991 and 1992, ended with many fewer issuers. And as a consequence of many fewer issuers, when the market rebounded, really as a consequence of the diamond discoveries, 1992-93, the recovery in the market was astonishingly violent. And at some point in time, you will see a recovery in the junior market, too. It may be 18 months from now. It might be 2 years from now. Mercifully, and I say this advisedly, mercifully, a whole bunch of issuers that don't deserve to be here won't be here for that recovery. The better projects will get financed. They always do. And it's my suspicion that on a going forward basis, Sprott will be able to finance companies because we think the issuers are finally going to be drawn to realistic pricing as a consequence of the fact that there were so many really generous, i.e. delusional funders available in 2009, 2010 that are no longer capable of funding, that the issuers will have to come to those parts of the mining finance community or mining investment community that have rational expectation and rational pricing.
Rick, what's the takeaway from this? Once the smoke starts to clear, are we going to be able to figure out a little more carefully what's going on with the value of these companies?
Oh, this is simple. Bear markets cause bull markets. Your readers have to understand that, your listeners. And bull markets cause bear markets. There is nothing in the narrative between 2009, 2010 in the bull market and today's narrative that's changed. There's not one thing that's changed. They are still making fiat currency worth less. No G20 nation has a balanced budget. The global banking system is still enormously challenged with bad assets and insufficient equity. The whole set of circumstances that people used in their own minds to take precious metals and natural resources up in the bull market is completely unchanged between then and now. What's different is paradigm and price, which is a different way of saying a bear market, especially an ugly bear market like this, is a sale, a truly spectacular sale. It may not turn around in a time frame that's convenient for you, and it may be that the fact that goods on sale it may be that the fact that goods are on sale is inconvenient to you if you have too many of your own goods, which you would like to sell from your own portfolio. But that notwithstanding, the length and the severity of the decline are the architects of the structure of the rebound. We will see it. Will we see it in a year? I don't know. Will we see it in 18 months? I don't know that either. But what I do know, this is my fourth cycle, bear markets cause bull markets.
Rick, all we need to do here is just to simply ignore the short-term noise, I guess, and try to get through the next 3-4 months.
Well, you also have to do in bear markets what you should have done in bull markets, which is ruthlessly prune your portfolio. If you have stocks in your portfolio that don't have the cash to last 18 months, sell them before they sell themselves. People look at a 6-cent stock and they say, how low can it go? I'll tell you, it can go to zero. Yeah. Then they say, Rick, I can't sell this stock for 6 cents because I paid 60 cents for it. Yeah. You know what? The stock doesn't care what price you paid for it. What price you paid for it is irrelevant. The only thing that matters is what's the highest and best use of the 6 cents. So prune your portfolio ruthlessly. Only focus on properties that can deliver a catalyst in the next 12 months. Only focus on management teams that have a prior track record of success and a prior track record of success that's very, very, very germane to the task at hand. And only keep companies in your portfolio that are strong enough to survive. My friend Doug Casey used to famously say, in a bull market, when the wind blows, even turkeys can fly. But what you need to do is make sure that the turkeys in your portfolio are well enough fed that they don't starve before the wind blows.
Rick, that is great advice. Rick Rule, founder of Global Resource Investments, a member of the Sprott Group of Companies. He's online at sprottglobal.com. Hey, Rick, thanks for taking the time to talk to us today.
Always a pleasure, sir.
This Week in Money is archived online at talkdigitalnetwork.com.
Ted Dixon is CEO of Inc. Research. Visit Ted at incresearch.com. Hey, Ted, for our friends who are meeting you for the first time here on This Week in Money, tell us a little bit about your background.
Oh, well, thanks, Phil, for having me on today, and appreciate that. And what Inc. stands for is Insider News and Knowledge, and what we do at Inc. is we focus in on what insiders are doing with stock in their own company in terms of whether they're buying or selling shares. And just like any investor, insiders can buy and sell stock in their firms, except they have to report it to security regulators. And what we do is we get a feed from both Canadian and U.S. regulators, and we package that up into a format that makes it a lot easier for investors to understand what's going on in terms of what executives and big shareholders are doing in relation to the share price and some of the fundamentals.
Pretty good day, Ted, on the TSX TSX today back over 12,000, but still in the red year to date. How the heck are we going to make money in this market? A brilliant idea that you have is simply to follow what insiders are doing.
Right. And insiders really are what we call the smart money in the market, and that there's probably no one who knows anything better than the health of not only a company but also the industry, than the executives that have the boots on the ground and are running the show. And what basically we like to say is there's three kind of rules of thumb that you want to keep in mind when looking at insiders. First of all, that insiders usually go against the herd. Okay, so they like to do what everyone else is not doing. So when everyone else is buying, like in the internet bubble, they're usually selling. And right now, when everyone's selling gold stocks, insiders, I guess what they're doing, Phil? They're buying.
Exactly.
Right? Exactly.
Yeah.
So that's the first rule of thumb. Second of all, though, there are occasions when they do go with the flow, when insiders sell when everyone else is selling, and that's a very bad sign. So, that's one thing your listeners should keep in mind, is that if they see insiders selling when the stock's going down, that's not usually a good thing. But when they're buying and everyone else is buying, that's a very rare event and also a very good thing. And the third rule of thumb is that good things come in small packages, and that insider activity in smaller companies sends stronger signals than in larger companies.
Now, a lot of this information probably is out there, but it's not in the kind of useful form that you presented in, right? I mean, it's tough for us to follow what's going on at the best of times.
Right. So we have two solutions for your listeners. One is a free solution. It's called CanadianInsider.com, where people can go and look at a stock and look at our homepage, and they can get a list of stocks that have the most insider buying and selling, and they can look at a specific company and see where that selling or buying is taking place in relation to the share price. And we also have another free site called InsiderTracking.com, which focuses on North American stocks, so U.S. stocks as well. We want to dig down a little deeper, do some screening, look at a little bit more filtering, zero in on individual insiders. IncResearch.com is our subscription service for sophisticated investors who really want to use insider activity as a key tool.
Ted, it's not all hard and fast numbers here. Tell me how your sentiment indicator works.
Right. So you can look at insider activity not just from a stock selection perspective, but also from the overall market or the health of a particular sector. So what we like to do is, how we just in BC, anyways, we just had an election, actually now a month ago or so, and during that election period, there was a lot of talk about polls, right, and how there were polls. Well, in BC, the only poll that really counted was on Election Day. But what pollsters try to do is get a sentiment of what voters are thinking about. And what we do with our indicators is we poll every night basically what insiders are doing with their pocketbooks, whether they're putting money into the stock market or they're taking money out. And that's what our indicators basically try and do in a nutshell. And so what we're seeing is in Canada, insiders had been loading up on stocks, and they basically now have sort of done their buying, which is a very positive sign. And in contrast, in the United States, insiders have basically been selling and have basically done their selling, and so their selling is kind of cooling off here in recent market activity. So that, to us, is a really key differential between the two markets, in that you've got insiders in Canada who have been buying and insiders in the U.S. who have been profit-taking. So what that suggests to us is, looking out down the road over the next year, in all likelihood, the Canadian market's probably going to surprise people on the upside, and the U.S. market may surprise people on the downside in a relative basis. So, and again, insiders are doing the opposite of what you hear in the media and what you hear most investors are doing, and maybe people are listening and going and saying, well, Ted, that doesn't make a lot of sense because the market's going down and insiders are buying. I don't know about that. And boy, those Americans, why are those insiders selling? The market's going up. But when you look at their past track record, while insiders tend to be early, they tend to at least make money over the long haul. So something to pay attention to.
Ted, always makes me scratch my head when we're talking about this stuff. How there is such a huge disconnect between what's really going on in the markets and what the financial press is reporting.
Well, I think that a lot of the financial media take their cues off of what the indexes are doing during the day and during the week. And so when you have this big upswing in the U.S., everything must be going great, right? Because you've had an upswing. Sure. And now lately, of course, it's come off. And so there's been some shaking of kind of head scratching going, well, is this just a correction or is there something deeper going on? But, if you look what insiders have been doing in the U.S., I mean, they've been selling into this rally. And while investors in general may not have been selling in May and going away, insiders certainly were.
Ted Dixon from InkResearch.com, our guest here on This Week in Money. First heard about you, Ted, a couple of months ago. Somebody sent me the link to the great Darcy Keith story at the Globe and Mail. Junior mining stocks see record insider buying. Now, we always talk about mining stocks and how beaten up they are. What can we learn from what's going on? What can we find out from what insiders are doing with the juniors?
Well, one of the key characteristics of insiders is that, they go against the herd. And as part of that phenomenon, they tend to be early. So, and there's probably a lot of reasons for that. Given their earlier investments in the company, their average costs and the like. But there's kind of a long list of why they may be doing that. But the important thing for investors who are following insiders to keep in mind is that insiders are early. So this is good news. This is good news because if you follow the insiders and you see that they're buying in a down market, that doesn't mean the insiders are buying, I have to rush out and buy. Yeah. What it means is it's a signal that there's bargains around and you can start looking for them. And in a down market, you can start hunting for those types of companies with strong management, good assets, cash, ability to raise capital. It's time to start putting your eye on bargains as opposed to exiting or forgetting about the sector. If you're a long-term contrarian type investor, if you're a short-term momentum, you trade, your day trader will know, then that's not the way, it's not going to appeal to you. But if you're an investor as opposed to a trader, then you definitely want to take a look at what, the mining area right now, because when you think about it, when you look at it 3 years from now, who's going to be making the money? Is it somebody buying a small stock that's got good management that's trading under cash, or is it going to be trading? Is it going to be buying a social media stock in the U.S. that's trading at over 1,000 times trailing earnings? So,
I think we've seen this movie before, haven't we?
I think so.
Ted Dixon from InkResearch.com, our guest here on This Week in Money. We're talking about Ted Service and what happens with miners. We have been talking all year long about the sad state of the mining industry here in Canada. What are you seeing with insiders in Canada's mining industry at this point?
Well, I think you got to focus in on the gold sector because of what's happened there, and we saw a spike of insider buying early in May, late April. And the insider buying really surged, and now it's kind of cooling off. And what that means to us is, as we see this kind of cooling off and insider buying, even as the market's coming down, it's kind of it's what we'd call sort of a hilltop rollover in sentiment, in that insiders have kind of done their buying, and now basically a lot of the bargains have been scooped up, or the insiders have gone in and done their purchases. They're usually early, and the market's still moving to find its levels, but generally speaking, this is the typical sort of signal that you get near some sort of an inflection point. I mean, today, as we're speaking right now, the gold's testing 12,000, but the mining stocks are still up for the day. So we need a couple of more days of this, and hopefully it will. For those who are investors in the industry are looking at it, hopefully we will get some stability here. But we think, based off of insider activity, that now's a very, very good time to start looking at accumulating gold companies, and we're talking about long-term accumulation, not jumping into the market and doing a day trade here. We're talking about looking for bargains.
Just about gave me a heart attack there, Ted. You said gold 12,000. I thought, boy, that's a big jump from 1,200.
1,200. Sorry about that. Well, the Freudian slip. No, we're certainly not. Implying that some insider activity gold's going to be doing a jump like that. No, 1,200 exactly.
Now, what about the TSX Venture? It behaves obviously different from the main TSX exchange.
Well, it's smaller companies, so you're going to see more activity in those companies, and in general, because usually insiders are more active. So you have to keep that in mind. And it follows the mining sector quite a bit, and we've seen heightened level of insider activity over the last few years in the junior mining space. So for a long-term perspective, it's so underloved by the general investing community that insiders are saying, if you're a contrarian, the bargain hunting is this is the season.
Okay, so lots of insider buying in the juniors. What about the biggies? What's happening at the big names in the gold sector?
The nice thing about, particularly in the gold space, we have seen a broadening of insider activity. We're seeing it in some of the larger names and in the smaller names, and we're seeing it geographically. We're seeing it, companies that have operations around the world, whether it's in Asia, whether it's in Mexico, Canada, Europe. We're seeing it across the board. So, the insider activity has been quite broad.
Ted Dixon from InkResearch.com, our guest here on This Week in Money. And Ted, fascinating stuff. How does a subscription to Ink Research work? Tell us what it does and what I can expect from it.
Well, a good way to start is by looking at our free service, CanadianInsider.com, and anytime you can kind of upgrade to click over to Ink Research and try our service. First-time users get a 2-week free trial. So it's a subscription-based service. So your initial subscription comes with a 2-week period where you can cancel, and if it's just not for you, off you go. But essentially, you'll be able to screen by sector, by size of company, those companies that have strong insider activity, either on the buy side or the sell side. Or if you just have a group of companies in your portfolio, you can put them on watch, and you'll get an alert from us when there's insider activity in those companies. So you want to keep your eye on whether the CEO or CFO in particular are buying or selling shares in that company. So it really helps you do some due diligence before you buy and stay on top of your investments after you buy.
Ted, how about some final soothing words for our friends who are trying not to follow the herd here?
Well, it's always hard not to follow the herd, and that's why it's important to follow insiders, because the human reaction whenever there's a loss is fear, and if you find out that insiders are buying while everyone else is selling, it at least allows you to have that gut check in terms of, okay, if I were starting from day one today, would I be buying or would I be selling? And looking at the insiders will help you sort of maintain that discipline.
Ted Dixon is CEO of Ink Research. Visit Ted on the internet at inkresearch.com. And don't forget, if you want to follow Ted on Twitter, that's easy too, at Ted Dixon. Ted, it's great to meet you, and thanks for talking to us.
Thanks for having us.
Thanks to our guests, Peter Schiff, Rick Rule, and Ted Dixon. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.